Energy markets are volatile, but your wealth management plan shouldn't be. If you're at an oil and gas firm like ConocoPhillips, Shell, ExxonMobil, Technic FMC, Weatherford, or many, many more, you have unique executive compensation, high incomes, and employee benefits to navigate. Today, we're going to chop it up about taxes, investments, and money management to help you secure your lifestyle now and your retirement future. Let's chop. Oil and gas executives and employees have a lot to think about when it comes to their deferred compensation, equity compensation, employee benefits, and managing their high income in a very volatile market. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way. And as usual, if you like what you hear, see, and feel on this show, hit the subscribe button and share with your colleagues, family, and friends. All right, let's chop. Wow, I grew up in Texas, where the oil and gas industry is just a huge thing. And my wife is from Saudi Arabia, so we have oil and gas there for sure, right? And the people that we serve here at Concurrent Wealth Management, we've been serving executives for a very long time. And specifically to the oil and gas industry, it's very volatile, ebbs and flows. And with that, folks want to wealth and well-being smooth over time to handle the cycles and also manage those very generous compensation packages that have equity, high income, and deferred compensation. And this is what we're going to talk about today, how we help folks and what we commonly see and some mistakes to avoid. So let's get into it. What is unique about oil and gas compensation to executives and employees? Well, first of all, equity compensation in the form of restricted stock units. Now, we have a show about RSUs, as they're called. So check that show out, then come back over here. Restricted stock units are stock units that are granted to employees that become valuable when they vest. All right. And then you can sell them afterwards. Now, the key thing with RSUs is there's no tax when they're granted. However, when they vest, a large tax bill can be due because taxes are due at the vesting period. And a lot of folks say, okay, well, what do I do about this large tax bill that I have in my hand? Unexpected, by the way. And how do I go about managing the RSUs after vesting? Do I sell now? Do I sell later? We'll talk about that more in the next segment. But RSUs, restricted stock units, are not unique to oil and gas. However, a majority of highly compensated employees at oil and gas firms receive RSUs. RSUs are very popular in oil and gas and also tech. So knowing how to manage the tax obligations at vesting and knowing how to sell RSUs afterwards can have a big benefit to managing your life and finances. Here's another thing that we see at executive compensation at firms, specifically like Aramco, BP, ConocoPhillips, deferred compensation plans that are tied to the performance of the energy sector and the performance of the company overall. And with energy markets being volatile, ebb and flows, they can have solid years, year after year, and go into either a sideways performing market or a bust. And then bonuses are lower at that particular time. So how do you go about spreading out deferred comp, or do you receive it immediately? How can you use your deferred compensation strategies in order to wealth smooth or lifestyle smooth during those sideways or bust periods in order to fill the gap during those years and make it seem like it's a booming year? So being mindful on how to smooth over time is a very valuable strategy in order to make your time in the oil and gas industry feel more consistent and not be so susceptible to the volatility of the boom and bust periods of oil and gas. For example, large RSU positions coming due at vesting, say that you have $500,000 coming vested to you in a particular year, that can garner a large tax bill, unexpected, by the way. Say, for instance, that you have $500,000 in RSUs that become vested in a particular year. Folks are really shocked by the tax bill. So if you sell immediately, then you can then use some of that money, set aside 20, 30% to pay for the ordinary income tax that are going to be due for those vesting shares, which is a good segue into part two, which is how do you manage taxes? Because the more money that you can keep in your pocket and not pay to the government, the more areas that you can fund as far as your lifestyle planning now and your retirement future. So as I mentioned, tax bombs are really popular with RSUs, a form of equity compensation, and bonuses. People are just simply shocked at the tax bill that are due. So being better informed and having a better strategy at the moment will help you keep more money in your pocket. For example, bonuses seem like they're taxed differently at the federal income level, because when you get your bonus check, you're like, wow, they took a whole bunch out. No, they're not taxed differently at the federal income level. They're taxed differently at the withholding level. So more withholding tax are taking out of bonuses than your regular salary. And to help smooth that out, you would adjust your tax withholding and your regular compensation throughout the year in order to offset that withholding chunk that's taken out of your bonus check and not give too much to the government and have an overpayment at the end of the year. Also, the oil and gas sector pays pretty good, right? So if you have high compensation, that means your marginal tax bracket is 37%. Now, mind you, not every dollar is taxed at 37% because there's a progressive tiered process on paying tax all the way up to the highest bracket, which is 37%. That said, still a lot of your money is being taxed because at each tier, your money is being taxed, and you have some money that is susceptible to that 37% ordinary tax. So if you're not taking any strategies in order to mitigate or reduce exposure to those higher tax brackets, then you are not keeping a lot of your income to fund your lifestyle and your future retirement. So strategies like reducing your taxable income by contributing to your 401ks pre-tax, maxing those out in order to reduce your annual income. Also, after tax, although you don't get a tax break for that, you are still contributing money to those plans after tax and getting the tax deferral that you otherwise would not get in a brokerage account. We have a show about brokerage accounts. Check that out because there's a lot of flexibility with taxable brokerage accounts. Even though they have the bad word taxable in there, there's a lot of tax benefits in there also. Here's the thing with after-tax contributions. After your salary deferrals, you have a gap between what you can contribute with your salary deferrals and your additional employee and employer contributions all the way up to $70,000. There's also catch-up provisions as well up to $70,000. So you can get a lot of money into your 401k using after-tax. And then if you roll over those after-tax monies into a Roth IRA, then you're taking advantage of what we call a mega backdoor. And then with that Roth IRA, those distributions during your retirement, that retirement income is tax-free. So here's another way to use your high income to pay your future self tax-free. And lastly, there's this special election called Section 83B that helps you accelerate your tax payment now and then paying it in the future. For example, on equity compensation, RSUs, for example, you pay tax at vesting. For example, if you elect Section 83B on restricted stock units, then you could accelerate the payment to paying now rather than at vest. Now, there's a whole bunch of steps that's involved into that, and we'll have a show on Section 83B, so stay tuned. That's why you're subscribing, right? Startup companies like taking advantage of Section 83B because they pay taxes on what the shares are valued while the company is brand new, rather than when the company explodes later and they would pay taxes on a value that's higher. All right, to summarize some of the common mistakes that we see oil and gas executives take with their high incomes and very generous employee benefit packages are not smoothing out deferred compensation over time in order to fill in gap years where salaries and bonuses may be a little lower. and using those monies, those deferred comp monies, to fill in the holes, smoothing out lifestyle now and using deferred comp in future retirement years. So let's pivot from common mistakes to what can we do to be proactive with your generous employee benefit packages and compensation packages in oil and gas industry. Well, one of them is, as we mentioned, which is smoothing out your deferred compensation over time to fill gaps. Another thing you want to avoid and be proactive about is when you receive your RSUs and you become vested, you don't want to really hold on to a lot of company stock. Yes, concentrated employee stock positions can be very beneficial either through your RSUs or your employee stock purchase plans. Sure, the company can be doing well, but what if the company doesn't over time, right? Here's how you can be proactive and avoid being overly concentrated in your company stock through your RSUs or your employee stock purchase plans. Sure, concentrated positions can generate a lot of wealth, particularly if your company is doing well. However, especially in the oil and gas industry where the market is very volatile, companies can pull back very quickly. So having a 10, perhaps 20, depends on your situation, your company, and your liquidity and your goals, stock position in your company could bode well for you. However, 30, 40, 50, 60, 80, 90% stock positions, that's not going to be well because you have all your eggs in one basket. So you want to take some proceeds from your employee stock purchase positions and your RSUs and diversify your portfolio in order to avoid such a concentrated stock position. Here's a tip that we help oil and gas executives with being proactive, not being overly concentrated in stock. So the key is to have an investment plan beforehand. So when you have RSUs or you participate in your employee stock purchase plan, what are you going to do over the course when you receive monies from those, right? You don't want to have to act in the moment and get a tax bomb or have too much income in 1 year or have too much concentration. So perhaps selling, say, 25 to 30% of your positions every quarter across over the years, right, will help you divest of concentrated stock positions and become diverse in your overall portfolio, shifting some of those monies into more diverse positions. So another thing we see in the oil and gas industry is early retirement packages, right? So people want to be proactive and be prepared for when those come. Early retirement plans are typically known in the employee benefit documents or they're announced. So having a plan to take advantage of early retirement if you're ready is better than not having a plan. And knowing that that early retirement is available, then you can start proactively planning way beforehand. So as you can see, if you're in the oil and gas industry, there's a lot to think about, whether it be deferred compensation, supporting your lifestyle now, or supporting your retirement later, equity compensation in the form of RSUs or employee stock purchase plans. What do you do to avoid tax bombs and be proactive rather than reactive? That way you can keep more money in your pocket to fund what you value most. All right, that's what we got for you. If you like what you see, hear, and feel on the show, as always, please hit that subscribe button and share with your family, friends, and colleagues. And until next time, we'll chop soon. Cheers.